Welcome back, and joining us on the show now is James Anderson. He's Senior Market Analyst at SD Bullion. James, hi, thank you so much for joining in. And the gold prices have been on a one-way run, $700 up in this year and perhaps 1,000 and more up in the last 12 months as well. Now that we are above $33.50 an ounce, where do you see prices heading?
At these points where you start to break out to new all-time highs, it's really hard to gauge in the short, medium term where it could go. You know, I saw Gary Wagner on Kitco News the other night doing a Fibonacci chart, and this is before the recent pop. And he was saying that, you know, with the Fibonacci chart, I posted it on my Twitter handle, he was saying the top likely it could get to 3,500 by the end of May. So, you know, in the interim, you could have a run beyond 3,300, 3,400, up to 3,500 even by the end of next month.
3,500 as soon as at the end of next month. Well, who's buying this gold now, James? Because we've seen jewelry bars in India now kind of hesitant with the kind of volatile high gold prices that we have seen. But do you think that central banks, ETF investments, and that perhaps could continue?
I see it in the derivative market mostly. I think mostly what you're seeing right now is hot money coming in this trade and the momentum side. And you know, obviously, like you mentioned, ETFs and central banks. I mean, it has to be known and driven home. Most people don't understand that pretty much since 2022, 2023, 2024, central banks, especially emerging market central banks, have been buying gold at record volume. I mean, you can go back to World War II. We've never seen this amount of official gold bullion tonnage being purchased by central banks. What it reflects is a bullion over bonds trade, and that is a phase transition. That is something that's not just happening in the short run. That's something that's likely happening on the long run, where central banks are moving back toward the old allocation of having 30, 40% of their liquid sovereign wealth in outright gold bullion reserves. So that's on a longer term scale. I think people have to kind of adjust their minds to understanding that we're going back toward the old money, which is gold being the numeraire that matters most.
Oh, well, absolutely. But James, every bull run has a correction, and gold hasn't done that for a while now, while the momentum still is on the higher side. Do you see gold at some point in time get a correction, even a healthy one?
Yeah, every bull market, every one of them has to climb a wall of worry. Okay, so 3,500, if it goes there, say, at the end of May, and it recedes and it goes back and retests 3,000 or goes below 3,000, you have a 200-day moving average of gold that's at 2,700 roughly and rising. Okay, so it is possible that you could have an interim top where it goes toward that 3,500 number and then crashes back down over the North American summer, where it dips again below 3,000, because those levels, 1,000, 2,000, 3,000 for gold, they are always a wrestling match. They don't usually happen. We've already had one break above it, one test below it. And I think ultimately we may get one more test below it when it's all said and done. And that's my hunch, is that this summer we'll see that one more test below. And it's very common in the bullion bull market for gold to retest its 200-day moving average. But the thing is once it's done that, generally silver goes nuts. So that's the other thing that we can discuss.
Well, I was coming to silver really, and we have seen silver kind of underperform gold in last year and in this year as well. Where do you now see silver prices by the end of 2025?
So I think the general bullish consensus in the global, silver analysts, it's basically 38 to 42 has been more or less the general consensus for the year in terms of, silver's high, $38 an ounce, $42 an ounce, somewhere in that area. There's other people out there who think it could go higher and faster and retest that old ancient nominal high of 50 an ounce from 2011 and 1980. What it does by the end of the year, it's not really so concerning to me, because I see this more as a long-term trade. I'm holding bullion through this decade into next, because ultimately I see the gold-silver ratio crashing back down toward where it went in 2011. I worked, traded, invested through 2011's silver and gold bull market. This bull market that we're in blows that away. That bull market was a pipsqueak joke compared to where we're going in this one. And so ultimately, when I look out, I think in terms of 5-10 year timeframes. I don't think in terms of a 1 year trade. So if someone is going to get in this market to speculate, well, good luck, because silver's absolutely volatile, and you're going to get your head handed to you occasionally in the silver market. It's one of the more volatile and dangerous markets to be trading on a short term basis. But on a longer term basis, if you do the study and you do the work, and you understand kind of ratios and take the fiat currency out of the equation and use long-term ratios of silver and gold versus the S&P 500, say, or silver and gold versus, you can use bonds, you can use real estate, you can use monetary base, you can use a whole bunch of variations to kind of take out the noise of the fiat currencies as they start to devalue further and further to bullion.
Well, James, as you said, that the gold and silver prices are reacting to a lot of things. As of now, for gold, it really seems like a safe haven and a hedge against various things that are happening in the international markets. What is it that you would want to watch out from here on in sense of fundamentals? I mean, tariffs is one thing, geopolitics another, the fiat currency is the third thing. And then, of course, it also is about interest rate cuts, global central banks buying. Where do you have your focus on?
So the biggest thing for me as a United States citizen is knowing that we have the largest debt in the world of all time in terms of nominal terms. And our debt to GDP is almost at the level where Great Britain was after World War II, after the war. In order for them to get out of that, they had to basically debase the pound. And ultimately, I think that's where we're headed in the United States. We have to devalue the dollar in order to meet nominally the obligations that we've made. We have 36 trillion in debt. We have a deficit this year that's probably going to be over 2 trillion. It's on its way. It's even larger than last year. We have a situation of unfunded liabilities that we have to pay on in terms of Social Security, Medicare, Medicaid, et cetera. That's depending on who you talk to, a net present value looking out of over 100 trillion to 200 trillion. It's just unpayable sums, right? And so what are the options that generally happen in history for countries and empires that are kind of fading, going from a unipolar world to a more multipolar world? Well, generally what they do is they don't default, they just devalue the currency. And so as time goes along, the world is going to realize that the dollar is no longer as good as gold. It hasn't been as good as gold for a long time, but it's going to become painfully obvious that that is the case. And all of a sudden, you're going to get a mania in precious metals, gold, silver, and even platinum later on.
All right, James, thank you so much for joining us today. Manisha, thank you for joining in as well. And as bullish comments come in, gold making new highs, what is also going from strength to strength is the Nifty.